All right, everyone, we have a rare treat today. Brian Feroldi is joining us in the studio. And we're going to be talking about the importance of watching the business, not the stock. And we're going to be talking about 10 investing lessons learned, things to watch out for, things to avoid. And to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I'm doing quite well. Yeah, this is certainly always a nice treat when we're chatting with Brian. And actually, we are literally in the studio. You said here in the studio today.
Yes.
Usually that's not exactly literal, but we are sitting three aside here. So this is nice.
It's
Brian,
a rare privilege and a treat. So I
Yeah.
guess with that, Brian, welcome to Richmond, man. Glad that you made time to join us here.
Thank you, guys. It is so awesome to see both of you in person. I think it's been just about 2 years since we have seen each other. And like you said, it's just nice to be physically in the space where I'm recording with people. This is wonderful.
So, Brian, let's start with this. I got a text message from a buddy of mine, and he had put a pretty decent chunk of money into ARC, which is it's a mutual fund. I guess I'll go back to you, and you can tell me a little bit more about it. But it's a high-profile fund right now. A lot of people have some awareness on it, but it had done really, really well over the last year. It was a standout over the last year, but this year it's struggling. And I think why it's struggling is a little bit more reflective of maybe what our audience is feeling and dealing with generally. Stocks that have done really well over the last year right now have hit a little bump in the road, or maybe a large bump in the road. So I want to give this back to you, and we'll talk about this through the lens of watch the business, not the stock. But let's start with this mutual fund, this actively managed fund, ARC. Talk to us a little bit about why it's being so volatile right now and what that means for investors.
For investors that don't know, ARC is a series of very popular, actively managed exchange traded funds. And the lead investment manager of ARC is a wonderful investor named Cathie Wood. And she has become very famous, I would say, especially in the last 2 years, because she has made some extremely bullish calls on Tesla. In particular, she's also been a big proponent of Bitcoin, and she is an investor that focuses on disruptive innovation, and that's the way that her funds invest. She has been a highly public figure. She's all over CNBC, and in 2020, her investing style was in vogue, and all of her exchange-traded funds that are out there just exploded. I mean, they just went bananas through the roof. She could do no wrong. Her style was just in vogue. More recently, since February of this year, we've seen kind of a little reversal of that, where the things that were performing very poorly in 2020, energy stocks, really the laggards, were big time laggards, and those have become kind of the market leaders in 2021. And one of Cathie Wood's flagship funds, which is called the ARC's Next Generation Internet ETF, that's down about 26% from its February high. If you look at the individual components that are in there, they hold stocks, very popular stocks like Tesla, Palantir, Zoom, Teladoc Health. And if you look at those components, they're down far more. In Teladoc's Health case, which is a leading provider of telehealth services, that was a red hot stock in 2020, and it's currently down about 48% from its February high.
Wow.
So if you compare that to the overall market, something like the S&P 500, that is currently down about 0.5% from its 52-week high. So we've just seen a lot more volatility in growth stocks in the last couple of months than you would have seen in the overall market.
Brian, is there some aspect of like a reversion to the mean? Like both in terms of these stocks, in terms of Cathie Wood, in terms of, however you want to look at this, I guess, put another way, one of the things that you've done so incredibly is educate our audience on the fundamentals behind stocks, right? And looking at earnings and looking at the fundamentals of what makes a business valuable, right? And I'm curious, just your quick hit thoughts on maybe many of those stocks that you mentioned there. Like, did they run up too much based on fundamentals? Does that even matter? Am I formulating this right? Like, how do you think about that?
I think about it exactly the way that you just said. The stock is not the business, and the business is not the stock in the short term. Those two things are separate and distinct from each other. And you can have a business that's doing poorly and its stock goes up tremendously. GameStop, AMC, any meme stock that you can think of. There's a lot of businesses that if you look at the businesses are not doing well. They're just on the wrong side of history and wrong side of innovation, and yet their stocks are going up. Conversely, if you look at a company like Zoom Video Communications, that company had a phenomenal 2020. If you looked at the business, any metric that you can want to look at, revenue, margins, profits, customers, anything was just straight up and to the right. And yet that stock is currently down 42% from its Zoom Video Communications.
Yeah, 42%.
It's down 42% from its February high. That is just the way that the stock market works when you're investing in individual stocks. A lot of times when things are going well, investors become way too excited on the way up, and stocks just get way out of step with their fundamentals. On the positive side, when the tide turns, you see the exact reversal thing where investors become far too bearish on the stock. And this is why stocks are incredibly volatile. And if you're going to invest the way that Cathie Wood invests, and I have nothing but admiration for her, I think she is brilliant and wonderful. And I so support her investing style. You just have to know, if you're going to invest that way, that there's going to be extreme volatility in both directions, the good and the bad. And you can't have the good without also accepting the bad.
That's interesting. So let's zoom in on Zoom here a little bit. That was not intended, but worked perfectly. So when you said it's down 42%, Jonathan, his head almost exploded because he was thinking, does that mean from the beginning of the pandemic? No, it's from the high, right? So, you obviously do a lot of research on individual companies. Like, this is your thing, right? Like, this is what you get enjoyment out of. When you think in your kind of mental model or your Excel model, as it may be, how do you value a company like Zoom? And can you talk us through, because a lot of us, myself most certainly included, like, I don't intuitively understand, like, what is the value? So when you looked at, hey, this jumped up X hundreds of percent or whatever it was from its January 2020 number to an all-time high and it's down 42%, it's still above where it was in January 2020, right? I'm assuming offhand. But talk me through, like, how do you think about the value of this particular stock? Understanding that nobody has the precise value of any stock, but, like, how would you approach this mentally?
So I am personally a shareholder.
Okay.
So this is a company that I absolutely love. I love the business model. I love their product. I've used several of the leading video communication apps. Zoom blows them all away. If you've used the product, I think that you'll probably have a similar, it's just intuitive, it's easy. And I love their founder. I love the founder's story. He actually worked for years at Cisco Systems, and he wanted to build, he was in charge of their video product. And he said, I was embarrassed. I was embarrassed to go to work because I knew how to make this thing better and they wouldn't let me make it better. So he left to found Zoom because he wanted to build a video first company, and that's worked out remarkably well. And if you zoom out and
we're on fire here. We're on fire.
If you look at this company's performance since it came public in 2019, Zoom, even after the recent decline, is up 424%.
Wow.
So if you bought Zoom at the IPO and have held it for just 2 years now, you are up over 400% on your money. Now, if you rewind to the peak, and this company actually peaked in about September of last year, you would have been up over 750%. So it's given back a lot of the gains. But if you look at the long-term performance of the company, it's been phenomenal. Let me read some of the recent numbers from this company. It actually just reported on June 1st. So very, very, very recently. Revenue was up 191% to $956 million. That seems good.
Yeah.
That seems like a favorable result.
We'll take 191% increase. Yeah.
Yes. Net income went from 27 million last year to 227 million this quarter. That's a 9x growth in profits for the quarter. They now have $4.7 billion in cash on their balance sheet. The number of customers that will spend $100,000 on Zoom or more grew 160%. Those sound pretty good to me.
They do.
They have customers that are spending more than $100,000.
They
Yeah,
have
that's news.
almost 2,000 that are spending more than $100,000 or more this year. Everything I just said, if you just knew that in isolation, you would just say, wow, that sounds great. And yet this stock is currently down 43% from its high last year. Now, if you, again, go back to the beginning, you are up tremendously if you've been a buyer of Zoom and you believed in it from its IPO. But it just shows me the difference between the stock and the business. This business is on fire. It is executing incredibly well, and yet its stock is not rewarding shareholders for now.
Okay. So this is interesting because last year, there's story. I mean, a lot of the market is driven by story, and last year had a pretty incredible story, to say the least. We have this world that's going through a shift, and everything remote is becoming more valuable. And Zoom's story as a facilitator of that remote business strategy, just like you can see, this is a product that could be the face of change. So people bought into that narrative, and they bought into this business idea, and they get this incredible return, these incredible results. But I have this question now, because there's this phrase that we talk about, it's time in the market, not timing the market. Well, were they overly exuberant going into the end of last year? Is this pullback, is this actually a closer to reality of where this thing should appropriately be valued? Or is this just a small speed bump on the place to the moon? Because I think someone that saw, all right, it could be worth 700% more than it is from its low. It could be worth 400% from its low. Someone's trying to figure out, should I have stopped buying? Should I be buying the entire time because it's time in the market, not timing? Like, clearly, with the benefit of hindsight, someone says, all right, buy it at the beginning of last year and buy it now. Don't buy it in the middle. But it is interesting with something that's this volatile, and you are talking about an individual company now. You're not talking about the market as a whole. How do you know when you should be just buying the company?
The question you really just asked there is, what is Zoom worth?
Yes.
What is Zoom's value? Is its value $500 per share? Right now it's $350 per share, therefore it's undervalued. Is its value $200 per share? And right now it's $350, therefore it's still overvalued. When it comes to valuation, which is just trying to figure out what is this business worth, valuation is a very hard and nuanced thing. And valuation is something that trips up a lot of investors, myself included. Some companies are easier to value than others. It depends on what state of maturity they are in. If you take a company that is big, boring, and predictable, Johnson & Johnson. Johnson & Johnson has its fingers all over the world. It sells thousands of products. You can count on sales to come in of that company at a measurable rate year in and year out. It's an extremely predictable business. When you know that, Johnson & Johnson becomes it's easier to value that because it's not growing that fast and its numbers are very predictable. A company like Zoom, the numbers that I just spit off to you, this is a company that's growing at triple-digit rate. Its profits just went up 9-fold. From scale. They went from 27 million to 227 million in a year. That is a remarkably hard thing to value because the change in that business is so great and so rapid that coming up with a precise valuation on that is extremely difficult. I don't even try when it comes to businesses like Zoom. I will always look and say, what is the valuation that Zoom's trading at right now? Do I think that there is room for this business to continue to grow? And my personal strategy is to just buy great companies such as Zoom over and over again at better and better valuations in time. And if I can do that consistently and I'm right about the ultimate long-term direction of Zoom, I'll do fine and I will likely make money.
Let's dig into that. I'm not going to say Zoom. See how I went for an alternate way to go? All right, let's look at that point at better and better valuations over time.
That jumped out to me.
Okay.
Exactly. What does that mean?
So right now, we are recording this on June 2nd. Zoom stock is trading for $326 per share, roughly.
And what I want to point out, that does not mean, all right, it's trading at $326 per share, which means I'm only going to buy it for 320, 315. It doesn't actually have to do with the actual share price at a point in time. Is that accurate?
Well, that's just the current share price. Yeah. And if you compare at that share price, the current market cap of the business, aka what the entire business is worth, is $96 billion. So that is the way that I think about a business. It's market cap. It's if you were to buy this whole business, how much would it cost you? The answer right now is $96 billion. If you bought it in October of last year, it would have cost you $131 billion. If you bought it of April of last year, it would cost you $38 billion.
Wow.
So that just shows you the value, how that share price moving up and down can affect the valuation of the business. There are some simple valuation tools that investors can use to figure out what are investors paying for this company today. One of them I know we talked about in the show before is just price to earnings ratio. Right now, according to Yahoo Finance, Zoom is trading at 145 times trailing earnings. So looking backwards over the last year, this business is trading at 145 times its trailing profitability. It's also trading at about 87 times forward profitability. So the business is expected to grow its profits pretty substantially over the next 12 months. And if you look at how it's valued on those profits, it's trading at about 87 times. Both of those numbers are rich. The entire stock market is trading somewhere around 24, 25 times earnings. So Zoom is many multiples above that because investors are expecting continued growth in this company. So if I was the way that I would buy a company like Zoom is if I was interested in the company, I would buy some today. I would take a small part of my portfolio. I buy in 0.05% increments, so half of 1%. And I would
your net worth.
Of my investment portfolio.
Okay.
Yep. I would buy Zoom and I would just write down, okay, right now I'm buying today. The price is $327. It's trading at 145 times trailing earnings, 87 times forward earnings. Its price to sales ratio is 37. So for every dollar in revenue, this company is valued 37 times its current revenue. And I would mark those down. Then I would wait and I would watch the company and I would wait for it to produce another quarterly results. And then we would get updated numbers. When the quarterly results come out, I say, what happened to revenue? Well, in this case, it just grew by 191%. Sounds good. What happened to profits? Profits grew by eightfold. What happened to the stock price? In this case, the stock price went down. If I thought that the business was executing, pretty clear that Zoom is executing, I would add to my position. I would buy another 0.05% with the goal of buying it at a lower price to earnings ratio and a lower price to sales ratio. That could happen because the stock price is down, therefore the valuation is lower, or the stock price is up, but it's up less than its sales are up. And it's up less than its profits are up. So therefore, I'm trying to pay less than 145 times price to earnings with my next purchase. And I'm trying to buy the same stock over and over again at better and better valuations over time.
Interesting. Okay, that all makes sense. I'm curious now about the 0.05.
Yeah, I thought maybe you just assumed the sale. Like, yep, that makes sense. I was like, all right, what's the portfolio? What are we talking about here?
Yeah, like you've identified, let's say hypothetically, you've identified Zoom as a company you want to buy. Do you set a target of the percentage of your portfolio that you eventually want to own from day one? Or do you just I have so many questions. How do you approach, why the 0.05? Do you set that target? And how do you know when to stop or when new information comes in? I want to stop buying. I want to sell. Like all of these inflection points are tied into how the heck do you even approach this?
First off, I made up 0.05%.
Nice.
There wasn't regression analysis that said that this is the way to do things. I've learned the hard way that you have to know yourself as an investor. You have to know yourself. If you rewind the clock 5-6 years ago, I became overly confident in a pipeline company called Kinder Morgan. The ticker symbol there was KMI. It checked so many boxes when I looked for a great investment. And I decided to put 5% of my portfolio into it and add on a bullish options position. Options allow you to add basically leverage, for lack of a better word. Actually, that's exactly the word.
That's exactly what it is.
Don't need a better word.
It was my number one position by far. I thought the company was immune to energy prices and all that kind of stuff just by the nature of the business. Spoiler, I was wrong. That stock fell 70%. And I learned a very painful lesson, which was no matter my conviction, I can still be wrong. Therefore, I need to not overweight in any given stock. And the way that I've learned to invest is to let my portfolio concentrate itself. So I buy in very small chunks of companies that I think have enormous potential ahead of them to grow. If I'm right, the growth of that stock will make it a larger and larger part of my portfolio. If I'm wrong, it's irrelevant because it fades away into obscurity and my biggest winners come to dominate my portfolio. By the way, that's exactly the same way all index funds work. It's exactly the same way the S&P 500 works. If you invest in VTSAX, the majority of your money is going into Apple, Microsoft, Google, Facebook, Berkshire Hathaway. Why? Because those are the biggest components. They have earned through sheer growth, they've become the largest components of the index fund. And the reason that index fund investing works is because your money is buying these companies, and the index is being powered by the biggest winners. A small subset of winners power the entire gains of the index funds. It's something like 7% of stocks that are in an index fund account for all the gains. The remaining 90% basically tread water. My portfolio is designed to do the exact same thing, where I let my biggest winners concentrate to become my biggest positions, and I don't pick them, the market does.
So there's a couple kind of lines of reasoning that I think we should explore. One of them is actually going back up the chart to where we initially started. And by the way, if you're watching this on the YouTube channel, there are some slides that we're showing right now that Brian has put together. And one of them on this first slide is, because we just basically pointed out that with the index fund, you are by definition picking a lot of losers. Like you're going to include a lot of losers in your fund. But on this chart, talk us through, again, I want to iterate that for people. What did the index fund with all those losers do at the same intervening amount of time as these funds that went gangbusters over the last year?
So if you look at the last couple of months, let's just back up to 2020 for a second. So many people that had never invested in the stock market before became investors in 2020. They were stuck at home. Maybe they thought about investing before and they finally gave it a try.
Took a Zoom class on how to invest.
I don't know how they finally came across it. Robinhood's numbers absolutely exploded. The number of people that were signing up for Robinhood accounts, people were getting money from the government, and a number of people that just became interested in investing exploded in 2020. Combine that with the fact that many of them became interested in investing after March, which is when the stock market bottomed. What those investors learned, unfortunately, is that stocks only go up. They bought any stock, and if you bought a very popular growth stock, you did phenomenally well instantaneously. And so many investors over the course of the next, from March of 2020 till February of 2021, the only thing they saw was instant success. Buy a great company, you are instantaneously rewarded. When you do that for 9 months, and that's all you know, how could you not think that that's market works? You had no knowledge of what happened prior to March of 2020 because you weren't involved. And when you became involved, stocks just went straight up and everybody was minting money. In February of this year, those same investors learned that stocks don't always go up. And the stocks that outperformed the most in 2020 have underperformed the most in 2021 because there's been a rotation out of high growth stocks into energy companies and really and into companies that were left behind, into banks, into boring essentially companies. But those have been the rock stars of the stock market in 2021.
So rotation, that's an interesting word. What does that actually mean? So there's been a rotation out of. Who's leading that rotation? Like I know this is an elementary question, but just bear with me because I'm sure people heard that word and don't understand, but I don't understand what it means. So like, how does that work in terms of a market filled with tens of millions of investors?
The stock market in the short term is very similar to fashion. What is in fashion right now is the asset that is going to outperform. That is going to be the thing that is going up. The way that big money managers work is they have billions of dollars of capital to deploy, and they try and predict what's going to be in fashion next, and they put their money into what's going to be in fashion next. What was in fashion in 2020 was growth stocks. Hence why billions of dollars poured from away from the energy sector, away from banks, away from real estate, into real estate investment trust, I should say, not real estate that you can buy a house, into growth stocks. And that is why, because all that money was pouring into them, plus all the money from individual investors, that is why those stocks went up so much. That is why that outperformance happened. It's very common for something to be in fashion, in vogue, have momentum for a couple of months or years, and then that momentum shifts into something else. So the things that got left behind in 2020 were energy stocks, were banks. In 2020, those have been the stars. Money is pouring out of high growth stocks, hence why we're seeing the drawdowns in those stocks that we've seen into those assets that were left behind. That the fancy word for that is just rotation.
Okay, interesting. And you said they try to predict what's going to be in fashion, but isn't it ultimately self-fulfilling? Like, aren't they causing it to that new thing to be in fashion when they're putting their money there, or does it not work that way?
As a herd, they are.
Okay.
Yes, I mean, investors are people, and people make decisions according to what they see. And if a trend starts, people feed into that trend and try and make it happen. So yeah, there's plenty of herd mentality with investors. You talk to any individual investor, they say they're a contrarian. In reality, very few of them actually are
We're prognosticators.
Exactly. So yeah, that's Wall Street's game. In essence, Wall Street is largely judged by what happens over the next 3, 6, 9 months, maybe year. And the game of money management is trying to figure out, where can I put my money right now that I get the best short-term returns?
So I want to kind of focus this a little bit more on something else you said there, which is, I let my winners run. And another principle that we talk about and that we see in investing is this idea, or this quote unquote need for rebalancing. And those two don't really work together. They're kind of the opposite idea. One says, let it run. And the other says, no, pull your profits into your underperformer. And I'm just curious, how do you look at that? How do you mesh those? And what are your thoughts on rebalancing and where it fits as part of your investing strategy?
When I hear the word rebalance, I think holistically about kind of your entire financial picture. So I think about what percentage of your personal net worth is in bonds, is in real estate, is in cash, is in stocks, etc. So when I hear rebalance, my mind immediately goes towards, all right, stocks have done phenomenally well over the last 12 months, 24 months, 3 months, 36 months, whatever. I'm going to take some of that and I'm going to put that into cash. I'm going to pay off debt. I'm going to do whatever. That to me is when I think rebalancing. When it comes to just the individual, what you're invested in just the stock market, one of the most important lessons about investing I've ever learned is that winners tend to keep on winning, losers tend to keep on losing. There's plenty of nuance in there, just like with anything investing. But if you find a company that is really executing and really doing well, and its stock is performing over long periods of time, I would say the odds are in your favor that that company is going to continue to execute and continue to outperform. What's been one of the greatest stocks of the last 24 years? Amazon, right? The stock has gone to some interesting places during that time. But if you bought Amazon at any point over the last 24 years and you still hold it, you've done well. And that to me is a classic winner keeps on winning. You could have bought Amazon when the entire company was worth $100 billion. Everybody knew what Amazon was at this point. Everybody. And if you bought it when it was worth $100 billion, you are currently up 16-fold.
Wow. I could imagine going through that P&E ratio, that whole calculation that you just talked about, and looking at the 100 billion and saying, yeah, we've probably peaked. This is we've done a lot. This is a place to start looking for other things that have the chance to 10x.
Yeah, and I guess to kind of piggyback on that, Brian. So let's say you were an investor, going back to your 0.05, right? Would you reassess and would you add money on a quarterly basis based on the quarterly reports? Like, how would you assess it? I'm still stuck on this because this is so intriguing to me. Like the intersection of the valuation of, hey, I have a thesis about this stock. and it's a buy for me. But how do I get into it over a long period of time? Talk us through like Amazon, for instance. So let's just say hypothetically, it's 2002. You have a concept that Amazon is going to be a juggernaut, right? You have your 0.5%, right? That's the threshold that you're putting in. So that's 1/200th of your investable assets, your net worth, right? So let's say you have a net worth of $1 million then. So 1/200th of that is $5,000. So talk me through like you're putting 5,000 in on what day? Is this like, hey, when I decide this, when I've made the determination that I want to invest, and then where do you go from there in terms of additional 0.5%?
Yeah. Okay. So to your point, yes, it's 0.5%. So on $1 million, that would be buying in $5,000 chunks would be the way that I would approach it. Amazon at this point is now a $1.6 trillion company. And one of the key things which is the way that I personally invest, is I have to believe that any investment I'm going after has multi-bagger potential. AKA, if I buy it, I have to believe that it can go up 100%, 200%, 300%, 400% from today. For Amazon to go up 100% from today, it would have to be a $3.2 trillion company. I think the entire GDP of the United States is 20 trillion. So that would be, Amazon is just worth 15% of the entire GDP of the entire US. They're different things, right? The size of a company and GDP, but it just puts it in perspective about how big $1.6 trillion is. Let's go back to when Amazon was $100 billion. And I believe it still had multi-bagger potential. I still think Amazon has multi-bagger potential from today, by the way, but it's certainly not going to 10x. It's not going to become a $16 trillion. As an Amazon shareholder, I would love nothing more than to be extremely wrong on that point. But when I'm buying stocks, it's a combination of three things primarily that I'm looking for at any given time. One, quality. I only want to invest in the highest quality companies that I can find, period. And I have a checklist that I take companies through, and it's the checklist that I use to determine business quality. Two would be valuation. How much I'm paying for that quality at any given time. And that would be very simply the price to earnings ratio, the price to sales ratio, et cetera. And number three would be potential. So if I'm right, how much can I make? And when I cover and track dozens of stocks, and at any given time, I'm adding to my portfolio continuously. And at any given time, I'm buying whatever in my portfolio is the best combination of those three things: business quality, potential, and valuation. So I'm trying to buy the highest quality businesses with the highest long-term potential that are trading right now at the best possible valuations. And I just buy that over and over and over again. Sometimes it's the same stock that I already own. Other times it's a completely different stock. But if I just continually do that process and I'm right occasionally, my entire portfolio should beat the market, because if I can buy the next Amazon when it's trading at $100 billion valuation and it goes up 10 or 20x, that will literally take my entire portfolio up to market beating returns.
Okay, I have one more follow-up question. So that all makes sense as a framework. Now I'm just like actual specific of, hey, it's June of 2021, and obviously you have a savings rate, right? And let's say, just for argument's sake, you saved $2,000 this month, right? When do you invest that money, and where does it go?
Because you don't just have one company, you have 10 companies. This rule of 0.05% is applying to 20 to 30 companies that you're beyond excited about based on your criteria.
Yep, I buy a few companies every month. That's just the way that it works. And cash is pouring into my portfolio continuously. One, just from my own personal income. Two, occasionally I'm selling stocks. That is either my decision, because number one reason I sell is I was wrong, right? If I'm wrong about a company, if I thought it's going to grow because of A, B, C, D reasons, and it doesn't grow because of D, E, F, G reasons, I would say, all right, I was wrong about that one, and I sell and I reinvest that into something that would be different. Sometimes companies I don't get bought out, and I don't have a choice. They're being taken away from me, and they become cash. I'm also reinvesting dividends, et cetera. But I'm investing continually into those companies. So how about we talk? Let's take a stock that I'm interested in today through this. So, do you guys ever heard of Pinterest?
I have indeed.
Okay. This is my wife's favorite company on the planet. and it has been for years. And I said, as soon as this company comes public, I'm buying. I don't care about anything else. It's just a ploy to get my wife interested in the market. It's been a great company to invest in. So Pinterest today, again, we're recording this on Wednesday, June 2nd. It's trading for $64 per share. At that valuation, it's a $42 billion company. It's currently trading at 229 times trailing earnings, 67 times forward earnings. So that shows you how much profits are expected to grow over the next year. And it's trading at 21 times sales. My thesis for Pinterest is as follows. I don't have the exact numbers in front of me, but this is directionally correct. Pinterest has 450 million users globally. The average user is monetized at about $1.20 a quarter, maybe $1.50 per quarter. The average Facebook user is monetized at about $9.50 per quarter. To me, I view Pinterest as the second most monetizable social network in the world. The reason I view that as, why do you go to Pinterest?
To buy stuff. You may not know it yet, but you go in there to figure out what you're going to buy next.
Pinterest calls itself a visual search engine. People go there when they don't have the words to describe what they want, but when they see it, they know it. You type in kitchen renovation, you type in yard games, you type in
insert Home Depot ad here.
That to me is an extremely monetizable thing, because you see a picture of a kitchen, if you're kitchen shopping, and you say, I want that. Doesn't that naturally lead into click this link to buy it? So I think that is an extremely monetizable platform, much more so than Twitter. I'm a heavy user of Twitter. When I go on Twitter, I go there to communicate with other people, to send tweets. Ads are a distraction. They're a distraction. When you go to Pinterest, ads are the reason you go to Pinterest. By the way, the average Twitter user is monetized about $5 per quarter. I think there's lots of room for Pinterest to grow from $1.50 per share up to Facebook levels potentially. So therefore, without acquiring any new customers, I think that they could 5x or 6x their revenue. And the number of users of Pinterest are growing 25% plus per year. You combine those two things together, I think there's lots of room for this company to grow its revenue. Let's say I'm right. Pinterest right now is a $42 billion company. If I bought the thesis and was interested in this business, I would buy $5,000 worth today on my pretend $1 million portfolio. And I would write down, okay, $5,000 buys me roughly 85 shares. I'm paying 229 times trailing earnings, 67 times forward earnings, and 21 times sales. Then I wait and I watch Pinterest. The next quarterly report comes out and I say, all right, how much did Pinterest grow? What happened to its revenue? What happened to the number of users that it's had? And I want to see signs that the thesis for owning Pinterest is on track. By the way, I have Pinterest's most recent quarterly results in front of me. Last quarter, Pinterest revenue grew 78%. Their number of users grew 30% to 478 million. And their profits grew by a lot. Is the easiest way to say it. Yes. So when I look at that report, I say, thesis on track.
Yeah.
I'm right so far about Pinterest. My goal with my next purchase, if Pinterest came up as a top idea for business quality, valuation, and potential, would be to buy it below 228 times earnings, below 67 times forward earnings, and below 21 times sales. So
what if you only get 2 out of 3?
That's fine. I'm just looking for signs that the valuation is better that I'm buying it at today. And if I'm right about Pinterest, Pinterest again is a $42 billion company. Facebook, for comparison, is worth $932 billion. Is there room between $42 billion and $932 billion for Pinterest to multi-bag? I think yes.
Okay. So clearly we don't have any idea about Pinterest, and normally we don't talk so hard about individual companies, but as a thought experiment and kind of going through this mental exercise, I definitely appreciate where, your logic and how you got to the enthusiasm that you have for this actual company. I would like to, you have a lot of things that you manage, and we hit on this, and we're not moving away super quickly because I think it's just, it gets complex when you are, am I just chasing my winners, which in your own words might be a good thing. And you kind of have some checks in place by saying, all right, well, instead of just, to keep myself from just chasing winners, I'm going to chase winners in the context of these valuation calculations being done appropriately. But as it gets more complex, you're not 1 month making one decision. You're potentially having the chance to make this decision about, again, 10 to 20 companies. So using this hypothetical of this individual that has, a $1 million portfolio invested over 18 companies. They've got somewhere around $5,000 this month that they're looking to invest from various sources, which is a whole unit of your self-described kind of, bar for investing in a company. And they have to make this choice about one of maybe 18 companies. Do you have 18 different companies that you're looking at to say, which one do I want to do? Is there a scenario where you're, making this decision about multiple companies? Because you can't have it all, right? With the restrictions that you've given yourself.
Correct. To me, the actual price of individual stock investing is time. Right. What I do, the process that I go through to invest in individual stocks and the way that I do it is time intensive. That alone should deter 98% of the population from doing what I do. And by the way, I don't claim that what I do is best. It's just the best version of that I've found so far. And I reserve the right to change any of this in the future. But yeah, the real price of what my style of investing, which is individual stocks, buying great growth stocks over and over again, it's time intensive. Everything I just described, I do for every single stock, and I've done this on hundreds of stocks. I have a spreadsheet that I keep track of literally hundreds of stocks that I'm looking through at any given time.
And I want to just point out for those of you that haven't actually seen his spreadsheet, he labels this spreadsheet fun. This is his idea
with an exclamation point.
Fun with an exclamation point, which means that if you could pick any single activity, with your set aside time as a guy that has a family and kids and hobbies and friends, like one of his highlight activities is just to go through this process.
Correct. I literally enjoy this stuff, which to me is the number one criteria for being an investor in individual stocks. It's, do you like judging companies? Is this fun for you? If the answer is no, if this is drudgery, just keep it all in an index fund and call it a day. And that's what 99% of the population should do. Or if you don't want to go to this level of detail in it, but you still want to invest in individual stocks, put 95% of your net worth in index funds and a tiny little bit in a couple of stocks that just really sing to you in some way. Your favorite companies. That way, if you're wrong about those companies, it's not going to hurt you financially. And if you're right, you could do well.
All right, I'm going to try to pin you down on this $5,000.
So I want to answer this one.
So again, Jonathan's hypothetical. Let's say you have 18 stocks that you are invested in some regard, right? You've got $5,000 to invest in June, and you have a couple of other companies that you've determined, hey, I want to get in, right? And again, using this random $1 million. So that would meet the threshold of I could potentially get a new company. Or I've got these 18 other ones to spread this money across or to concentrate said money in. How the heck do you decide what to do at that point? Is it just whatever's the most favorable numbers? Like, talk me through, like, brass tacks. What in that scenario, what on earth would you do in June of 2021 in this random hypothetical?
All right, let's get specific, shall we?
Let's do it.
So
I mean, I think it's kind of a simple answer, right? It's like
yes.
Do you only buy one? Or do you kind of break your own rules, fudge it, and just spread it out?
Yeah, not even specifics. Yeah, that general. And do you know what I'm getting at? Because I think so many people are hearing this and they're like, this makes sense to me. I love this, but I need that little extra bit of help.
Sure.
Just pretend it's me. Give me that help.
Sure. So
what would
again,
I do?
Money is pouring into my account constantly. I also keep right now, I think I have
But it's not even you. It's not even your account and your money. It's someone else who hypothetically has $5,000, like it's $1 million portfolio, and they have $5,000 in that account, and they're wondering, that's my baseline unit. That's all I have. They don't have money pouring in the account. They have this money, and maybe there's a little bit more trickling in, but they're not going to get to $10,000 before next month. So at their $5,000, they're trying to say, look at that chart that we were just looking at. They're all on sale. They all have great valuations, and I'm excited in varying levels, amounts, but actually all of them. But I don't know which one. And if I just spend $5,000 on one, I'm basically saying that that's the one over all the other 17 that's going to just shoot back up the fastest. Do I wait until I have 10,000 and then buy two? Do I just dump it all in Zoom because I just ran the price analysis and that's the most exciting? 5,000.
So I love that you're pinning me down. If you just look at the S&P 500, in any given year, the turnover rate of that S&P 500 is somewhere between, say, I'll make these up, they're close to accurate, 2% to 6%. Meaning, if you just owned all 500 companies, in every given year, a couple of them are going to get bought out. A couple of them are going to get kicked out of the index. A couple of them are going to get added to the index. And the overall turnover rate of the entire index is somewhere between 2 and 6%. My portfolio is similar, where I have companies that are getting bought out. I have companies that I'm recycling because I no longer believe in that, and I'm selling them. And that is a source of capital. Right there, let's say my turnover rate in my portfolio was 5%, which is fairly close to actually what it is. That right there is 10 buys. 0.5% times, divided by 5. That gives me 10 new buys with just my recycled capital.
You're saying something, but it actually has real implications, like for everybody. What you're actually saying is that for someone to hold even a relatively simple portfolio of 18 to 20 highly curated growth stocks that are anticipated to be winners, you're getting enough unforced churn to be forced to make the decision on what new companies do I want to put this into. So the whole idea of long, and again, I like your approach. So generally, I'm very supportive of this, but it's just worth pointing out to people the idea of just buying these companies for the long term and then just letting it ride. That's a fantasy. You're going to be presented with the opportunity or the need to reinvest both your gains and your unforced sellouts on a month-by-month basis. Is that kind of what you're getting at with this?
Yeah, you could do it monthly, you could do it quarterly, you could do it annually, you could do it over a period that you want. The S&P 500, again, if you own an index fund, this is happening automatically. This is just if you're doing it individually. Again, it's a manual process.
Okay.
And in general, with my portfolio, the way that I view my portfolio is I'm making my own index fund. I'm hand-picking my own index fund. And the idea is get the best I can possibly get in there, get the worst that I have bought out, and recycle that into the best continually.
And when we say index fund, we don't mean you're creating your own VTSAX. You're creating your own. It was kind of a hybrid, right? It's kind of more like an actively managed fund, except for the part where you're slipping in and out. You're trying to figure out when to get in. You're basically, I get out when the thesis change and the companies go into the tank, and the fundamentals don't match up, or when they sell or are bought out. Otherwise, I'm buying and holding for the long term. So it's a long-term buy and hold index fund with minimal churn, but there is churn, much like there is with an index fund. And then with that money that is then churned and put back into my account, I then have to make a rules-based decision, which your index fund is doing as well. And hopefully in the case of Vanguard, we talk about being done in a tax-optimized way. But this is actually really fascinating because a lot of us take for granted that this is happening even with our index funds that we hold.
Yes. So if you look at the holistic view, what I'm doing with my portfolio is very similar to an index fund. It's just a hand-picked, handcrafted, hand-recycled, hand quality screened.
Keep going.
Yeah,
Keep
exactly.
going.
As I said, it's a lot of manual labor. If you make a spreadsheet and it doesn't have the word fun at the top, you probably shouldn't do it.
Oh, that's great.
The word spreadsheet makes you cringe.
Right.
You probably shouldn't do it.
And another thing to keep in mind too is you need to track your results. You need to ask yourself, is all this work that I'm doing leading to alpha, aka market returns above the index? If the answer over long periods of time is no, then that means that you are spending time, money, and energy to make less money. That sounds like a pretty bad way to spend time. So if you are not beating the market over long periods of time, my personal yardstick is 5 years. That's what I judge myself against. If I'm not creating alpha over 5 years, then I've blundered.
Brian, this has been fantastic. Thanks for letting me and Brad kind of push on this, implementation, because I think it's very important for people to get a realistic view of what is involved. And I actually learned something in the process that I think we take for granted, in that our index fund is experiencing the same churn. It has experienced the same churn. And if you have a $1 million portfolio with even just 18 to 20 companies, you are going to experience some level of unforced churn as well. So that is really good information. But I think what was embedded in this is, how do we establish the value of a company? And even if we don't get it perfect, what's a process we could start to build towards to be able to come up with this information more quickly? The same tool that someone uses, when they're looking at the value of a house and they're trying to view what is the ROI on a potential purchase of this property. We should have something similar if we're going to go into the world of individual stock investing. Now, for our audience that's listening, Brian has a book that's coming out with Choosify Publishing later on this year, and we'll do an announcement on that in the near future, talking about why does the stock market go up. I've had a chance to preview the book. It's absolutely phenomenal, and we'll obviously give you more information about that as we get closer to the launch. But for those of you that were interested in this book when it comes out, but also really interested in Brian's exact process for evaluating these companies and the spreadsheet that Brian uses to go through this exact process. Brian has put all of that together for you. And if you want more information on that, just go to choosify.com/Brian. There's an option there to get early access for more information on the book, but also you'll be able to get access to that checklist and that YouTube video. And just put in your email information in there and we will send it to you directly. I will also say, I'm going to give this back to you, Brian. Over the last several months, you've started working, I would say over the last year, you've been working on a YouTube channel where you're doing these incredible, just easy to understand breakdowns of the financial tools that are out there, how to use them, what to expect, and how you analyze companies. If people are interested in checking out your YouTube and your Twitter channel, what is the best way to find you?
Yeah, on YouTube, me and my partner, Brian Stoffel, we take stocks that we've never heard of before, and we take them through and research them in real time. It takes us about 45 minutes to an hour, and we take a stock, again, we've never heard of before, and we take it through our checklists. And we give you just the framework for how we would go about researching a stock from scratch. That's what it's called, stocks from scratch. So if that interests you, my YouTube channel is just Brian Feroldi.
And for our audience, if you want to access the YouTube channel, specifically the video on analyzing the stocks and that checklist, just go to choosify.com/Brian. That's choosify.com/Brian. All right, my friends, the fire is spreading. We'll see you next time as we continue to go down the road less traveled.